The air at the Tiong Bahru wet market this morning was thick with humidity and anxiety. Aunties were comparing the sudden spike in the price of cooking oil, shaking their heads at the stall owners. That is exactly what the global institutional market looks like right now. The localized tensions in the Middle East have metastasized into a systemic energy crisis. The functional closure of the Strait of Hormuz has redrawn the risk parameters for every single equity traded in Singapore. We are no longer pricing in growth, we are pricing in survival. Our inner circle of Iggy's elite investors already know this, but the broader market narrative is becoming increasingly opaque. Navigating the Singapore exchange right now is exactly like watching the legendary chicken rice uncle at Maxwell Food Centre during a severe recession. He does not panic and suddenly change his entire menu to sell Western food. He tightens his supply chain, he negotiates harder with his poultry supplier, and he keeps his portion sizes precise. He survives by controlling his balance sheet, not by chasing trends. That is exactly what we are doing this week. We are stripping away the geopolitical noise to focus strictly on corporate resilience. Let us apply the 5-layer forensic audit to the Straits Times Index. The raw fact is that the index sits at 4,842.27, shedding marginal points over the week. Historically, this marks a steady retreat from the euphoric all-time intraday high of 5,041.33 that we witnessed in late February, retreating from that psychological resistance battle for the 5,000-point milestone. In terms of peer context, the Straits Times Index remains a fortress compared to regional counterparts, absorbing outflows far better than its neighbors. Looking forward, we anticipate a tight 10% trading band around the 4,800 level until the maritime blockade is definitively resolved. Finally, the wallet impact for a 55-year-old local investor deploying supplementary retirement scheme funds is that this relative outperformance protects your purchasing power against a rapidly strengthening United States dollar. So what does this mean for you? It means the Singapore market is absorbing the global shock far better than its regional neighbors, but avoiding a massive crash is not the same thing as generating organic growth. The index is merely stalling while inflation catches up. Smart money is actively rotating out of high beta technology proxies and aggressively hoarding balance sheet fortresses. Let us look closely at Geo Energy resources. The stock surged 17.4% this week to close at 0.42 Singapore dollars. Let us walk through the forensic layers together. The raw data shows the price hit 0.42 Singapore dollars, driven by a proposed 14.9 million Singapore dollar share placement. Historically, this company functioned purely as a volatile Indonesian coal play, trading at much higher debt loads. In peer context, an Altman Z-score of 6.0 and a low beta of 0.42 put it in the upper decile of sector resilience. Moving forward, the proposed capital injection provides a plus or minus 10% buffer against maritime operational delays. For a retail investor with a defensive portfolio, this low correlation provides essential ballast. Management must prove they can run a fleet as efficiently as they dig a pit. The total debt to total capital ratio sits at a highly manageable 24.4%, which is well below our 35% fortress balance sheet requirement. You are paying a fair multiple, but maritime acquisitions are notorious for hidden integration costs. Next, we evaluate China Aviation Oil. Presenter. Speak each letter individually, CAO, which serves as our direct proxy for energy market volatility and surged 11.5% this week. The raw fact is the stock closed at 1.59 Singapore dollars. Historically, the 5-year average dividend yield has been a modest 2.7%. In peer context, its massive 687 million United States dollar net cash position is practically unrivaled in the regional aviation fuel space. Forward scenarios suggest a 10% upside or downside based entirely on the timeline of the Sinopec parent merger. For the 50-plus investor watching their Central Provident Fund compound, this cash pile is a massive historical cushion acting as a true sanctuary. But the price to earnings ratio stands at 12.3 times. You are buying a fortress, but you are paying penthouse prices for the privilege of standing inside the walls. If the Middle East tensions escalate tomorrow, the speculative froth will evaporate instantly, leaving late buyers stranded at peak valuations. Let us turn our attention to Bumitama Agri Limited, which represents the agribusiness defense mechanism and clocked a 10.6% gain. The raw price is now 1.22 Singapore dollars. Historically, this stock yields around 9.8%, though the current yield excluding specials is flat. Compared to peers, its Altman's score of 11.0 is astronomically high, indicating zero historical bankruptcy risk. Forward scenarios hinge on a 10% price elasticity tied to substitute edible oil demand. For a domestic investor, holding this is literally like stocking up on rice at the supermarket before a major storm hits. It is fundamental protection. The stock moves almost completely independently of the broader index panic, acting as a secondary hedge when crude oil becomes too expensive. However, agricultural yields are fundamentally bound by weather cycles, not just geopolitical headlines. Now we must audit the collateral damage. Boustead Singapore Limited. Presenter, speak ticker letter individually. F9D suffered a painful 8.4% contraction. The raw close was 1.4 for Singapore dollars. Historically, Boustead is known for pristine capital management, but the weak initial public offering debut of its real estate investment trust shattered short-term sentiment. In peer context, its total debt to total capital ratio is a microscopic 6.5%, completely dwarfing the bloated balance sheets of rival developers. Moving forward, the stock faces a plus or minus 10% recovery window depending on subsequent real estate volume. For an older investor relying on steady dividends, this capital dip is a point of forensic interest but structurally contained. Imagine an older couple living in a mature housing and development board flat in Ang Mo Kio. They sell their fully paid off flat at a massive premium, then take that cash pile to fund the down payment on two smaller private condominiums, generating rental income while keeping some cash on the side. Corporations do the exact same thing with real estate. The underlying business is completely insulated from the real estate investment trust struggles. The price to earnings ratio has compressed to 9.9 times, pricing in zero growth for their geospatial and engineering divisions, which is a massive statistical anomaly. The banking and real estate investment trust sectors are officially pivoting from net interest margin expansion to wealth management preservation. Let us audit the yield spreads across the critical income counters by looking at the cash flow. The math here is non-negotiable. We calculate the risk premium by taking the asset yield percentage and subtracting our designated risk-free rate. For this audit, I'm applying a stress test buffer. I am using a conservative floor of 3.2% as our risk-free benchmark. While the current spot rate for 6-month treasury bills is around 1.36%, we need to test the thesis against a higher hurdle. If the math holds at 3.2%, the margin of safety at current levels is a fortress. We audit for the storm, not just the sunny day. To justify the risk, an asset must yield at least 150 basis points above that 3.2% floor. Let us look closely at Overseas Chinese Banking Corporation. Presenter, speak each letter individually, 039. The yield currently sits at precisely 4.7%. When we subtract our 3.2% forensic floor, we get exactly 150 basis points of yield spread. This means the yield sits precisely on our threshold line. While the bank boasts a massive common equity tier 1 ratio of 15.1%, its yield spread is hovering dangerously closest to our floor. Now consider DBS. Presenter, speak each letter individually. Group, with a distribution yield of 5.9%, subtracting our 3.2% floor gives us a robust yield spread of 270 basis points. This easily passes our 150 basis point threshold and firmly places the bank in the fortress category. On the real estate side, Mapletree Logistics Trust. Presenter, speak each letter individually. M44U offers a 5.2% yield. Subtracting our floor leaves a 200 basis point spread, comfortably passing the test. However, we must ensure this is organic net property income and not artificially engineered yield supported by sponsor top-ups. Then we have Parkway Life Real Estate Investment Trust. Presenter. Speak each letter individually. C2PU. Its current yield is 4.5%. Subtracting the 3.2% floor gives us a yield spread of just 130 basis points. This completely fails the 150 basis points threshold. Holding a trust with a 130 basis points spread in this macroeconomic environment is like standing at a bus stop in Yishun during a massive thunderstorm with a broken umbrella. You are taking on pure equity risk without receiving adequate premium compensation. You are falling into a yield trap where the distribution might look steady, but the underlying net asset value is slowly deteriorating. When terminal interest rates stay higher for longer, even the best hospitals cannot outrun a compressed yield spread, especially if they are hitting a debt wall where they must refinance significant debt at higher rates. Where do we get the data to separate market noise from intrinsic value? Every metric in this analysis, from the Altman Z-scores to the fair value targets and gearing ratios, is pulled directly from the Investing Pro screener. This is the institutional grade data engine that forms the core of our forensic stress test. You can use the discount code INVESTINGIGUANA to run your own forensic screens on Singapore Exchange stocks. We must contrast analyst targets against mathematical fair value. We are looking for the forensic gap, which is the difference between the Investing Pro fair value and the current market price. A narrative is just a story told by humans who have inherent biases and emotional attachments to certain counters. A math model removes that bias. It looks strictly at cash flows, historical multiples, and peer comparisons. When you rely on Kopitiam logic to explain complex macro concepts, you ground your expectations in reality. If a neighborhood uncle cannot understand why a stock is priced the way it is based on its daily operations, the market is likely pricing in a fantasy. The week ahead is entirely dictated by monetary policy and the impending Federal Open Market Committee rate decision. Let us apply the forensic rule to this event. The raw expectation is a total freeze on rate cuts. Historically, the market was pricing in multiple cuts just 30 days ago. In peer context, global central banks are universally halting their easing cycles. Moving forward, a hawkish statement will likely drag the Straits Times index down another 10% over the quarter as fixed income alternatives become more attractive. For a supplementary retirement scheme investor, this delay means your cash deposits will continue to yield decent returns, while your real estate investment trust portfolio will continue to bleed capital value. It means the era of cheap liquidity has officially been postponed indefinitely. The single pivot point for the week ahead is the resolution or escalation of the Strait of Hormuz crisis. Without a restoration of global oil flows, the drag from energy costs will entirely consume the benefits of incoming wealth management flows. For my own portfolio construction, I track the total debt to total capital ratio as a primary watch signal. This is a personal forensic boundary, not a recommendation. I am strictly avoiding capital-intensive trusts and focusing entirely on entities with commodity pass-through pricing power. Remember to always apply the 25% concentration rule. If your portfolio carries more than 25% exposure to highly geared, interest rate sensitive instruments, you are structurally offside for the stagflation regime we are entering. For a retiree in Tampines managing their central provident fund, the mandate is simple. Do not chase yield into burning buildings. Guard your capital. Wait for the geopolitical dust to settle and let the balance sheet fortresses do the heavy lifting. If you found this forensic breakdown valuable, make sure to hit subscribe. I am not a financial advisor. I am a forensic auditor of my own portfolio. This content is for educational and informational purposes only and is produced in alignment with the March 2026 MAS guidelines on online financial content. All data is sourced from public filings and processes through the Investing Iguana forensic lens. No part of this analysis should be construed as a recommendation to buy, sell, or hold any security. Investing in the Singapore Exchange involves significant risk. Always perform your own due diligence or consult a MAS licensed professional before committing capital.